18 months. That is how long you have to reposition your portfolio before the next massive transfer of wealth from the unprepared to the prepared. Not 2 years, not 5 years, 18 months. I have studied debt cycles for over 5 decades. I predicted the collapse of 2008. I saw the dot-com crash coming years before it happened. And right now, every single signal I track is flashing red at the same time in a way I have not seen since the late 1990s. We are in stage 7 of an 8-stage debt cycle. And the final stage historically destroys 50 to 60% of conventional portfolios. But it does not have to destroy yours. There are 4 investments that survive what is coming. Only 4. And in the next few minutes, I am going to show you exactly what they are, why they work, and how to own them before that window closes quietly and permanently. But first, you need to understand something that almost nobody in mainstream finance is willing to say clearly. These cycles are not random. They repeat every 75 to 100 years. The last one played out during the 1930s and 1940s. And when they end, they do not end slowly or gently. They end with massive wealth transfers from people who are positioned incorrectly to those who are positioned correctly. To make this real, let me tell you about a man I will call David. In 2005, David was 53 years old, disciplined, careful, and conservative. He had worked as an accountant for 30 years and built a portfolio worth $2 million through consistent saving and reinvestment. He followed every piece of conventional financial advice exactly as it was given: 60% in stocks, 40% in bonds, diversified across sectors, and managed by a well-known wealth management firm that charged him nearly $25,000 a year to guide his decisions. And the core advice they gave him above all else was simple: stay the course. In late 2006, I sat across from David at a conference and told him something very different. I told him we were late in a long-term debt cycle. That housing was dangerously over-leveraged beyond what historical data justified. That banks were holding toxic mortgage assets they did not fully understand. And that a crisis was coming that would be unlike anything most investors had experienced in their lifetime. I told him he needed to reposition into a small group of assets that actually survived these environments while the opportunity to do so still existed. David listened politely. He understood the logic. But then he did what most people do. He went home and called his advisor. The advisor walked him through decades of market performance charts, showed him that markets always recover over time, explained that diversification reduces risk, and reassured him that warnings like the ones I had given were the kind of pessimistic predictions that had been wrong many times before. David trusted the system, trusted the expertise he was paying for, and he stayed the course. In 2007, the markets continued rising. His portfolio grew to $3 million, and at that moment he felt completely validated. He began planning early retirement. His wife started looking at property on the Carolina coast. They booked a trip to Italy, and everything in his life seemed to confirm that staying the course had been the right decision. Then 2008 arrived, and in just 18 months his portfolio dropped by 56% too. $3 million became just over $1 million. Everything he had built over 3 decades was cut in half in a year and a half. And in that moment his advisor told him the same thing advisors always say: do not panic, do not sell, it will recover. But David did not have time on his side. He was 56 years old, and he needed that capital to continue compounding for retirement that was less than a decade away. The market eventually recovered, but not until 2013, And by then David was 61, and the damage had already been done. Even after recovery, he was nearly $900,000 short of what he needed. His retirement timeline kept getting pushed back from 65 to 67, then to 70, and today he is still working, not because he wants to, but because mathematically he has no other option. The vacation property never happened. The trip to Italy never happened. And the years that were supposed to be his most free became his most restricted. And this is the part you need to understand deeply. David was not reckless. He was not greedy. He did not chase risky investments or ignore advice out of ego. He did everything exactly as he was told by professionals, and it still failed him. Not because that advice is always wrong, but because that advice is built for the middle of a normal cycle and becomes dangerously wrong at the end of a long-term debt cycle. The advisor who told him to stay the course retired comfortably years ago, while David is still working into his 70s. And that difference is the asymmetry you need to understand before deciding what to do next. Now step back and look at the bigger picture. The economy is not random. It behaves like a machine driven by three forces: productivity, growth, short-term cycles, and long-term debt cycles. The long-term debt cycle is the one that matters right now because it unfolds over generations. Over decades, debt builds across governments, corporations, and households year after year, until eventually the system reaches a point where the total debt becomes unsustainable, where growth is not fast enough to support it, and where traditional policy tools stop working effectively. That is exactly where we are today. Total U.S. debt has surpassed $90 trillion. Government debt alone is approaching $38 trillion, and the government now spends over $1 trillion every year just to pay interest on existing debt, more than it spends on many essential sectors, and that is not just a statistic, it is a signal. When a system reaches this point, there are only three possible outcomes: defaults where debts are not paid, restructuring where debts are reduced, or inflation where the currency is devalued. And across history, governments consistently choose inflation because it is the least visible way to reduce debt burdens. They do not present it as inflation. They call it stimulus, liquidity, or monetary support, but the effect is the same. More currency is created, and the value of existing money declines over time. I have studied more than 500 years of economic history across different countries and different crises, and the pattern is always the same. When currencies weaken, paper assets lose real value. But certain types of real assets consistently preserve purchasing power. That is not theory. It is pattern recognition repeated across centuries. And in every one of these periods, there were four specific categories of assets that preserved wealth when everything else failed. Now, if you want me to break down those four assets in detail and show you exactly how to reposition your portfolio before this window closes. Now let's break down the four assets that have preserved wealth across every major debt crisis in recorded history. Not sometimes, not in theory, but every single time across completely different countries, currencies, and economic conditions. The first asset is physical precious metals, specifically gold and silver, not ETFs, not mining stocks, not futures contracts or paper claims that represent ownership, but physical metal that you own directly and can access without relying on any financial institution. The reason this distinction matters is simple. In a real systemic crisis, paper assets can be frozen, accounts can be restricted, and access can be delayed or denied entirely. But physical gold held outside the system cannot be frozen in the same way. For over 5,000 years, gold has maintained purchasing power through every major monetary collapse. And in the 1970s alone, gold moved from $35 per ounce to $150, a 24 times increase, while traditional portfolios struggled just to break even in real terms. Even in recent years, markets have already begun pricing in monetary stress, with gold and silver showing significant movement ahead of broader instability, which tells you this transition has already started quietly. Allocating 10 to 15% of your liquid net worth into physical metals is not about chasing returns. It is about protecting purchasing power when currencies are being systematically devalued, and it should be stored in locations you directly control, not within the banking system, because history has shown repeatedly that access to financial institutions can be restricted during times of stress. The second asset is businesses with genuine pricing power, not broad index exposure, not speculative growth stocks at extreme valuations, but specific companies that can raise prices faster than inflation because customers have no real alternative. Companies that sell essential products or services, maintain strong brand dominance, and generate consistent cash flow regardless of economic conditions. During inflationary periods, these businesses do not just survive, they expand, because while their costs increase, they pass those increases on to consumers and often raise prices even more, protecting and even increasing their margins. In the 1970s, while the broader stock market stagnated in real terms, companies in sectors like energy and consumer staples saw revenues grow dramatically because they controlled resources and products people could not avoid buying. The key here is to focus on businesses with proven resilience, companies that have survived multiple economic cycles, maintained profitability, and ideally increased dividends over decades, because that consistency is not accidental. It is the result of structural pricing power built into their business models. Allocating 30 to 35% of your portfolio into these types of businesses creates a foundation for real returns, even in an environment where inflation is eroding the value of currency. The third asset is short-term Treasury securities and cash equivalents. And while this may sound unexciting, it is one of the most critical components of a crisis-resistant portfolio. Liquidity is what transforms market crashes from disasters into opportunities, because when assets are being sold at deep discounts, the only investors who can take advantage of those opportunities are the ones who have capital available. In 2008, high-quality assets traded at fractions of their true value. And in 2020, markets experienced similar rapid dislocations. And in both cases, the investors who were able to deploy cash during peak fear generated outsized returns in a very short period of time. Holding 20 to 25% of your portfolio in short-term safe instruments is not about maximizing returns today. It is about ensuring that you have the flexibility to act when rare opportunities appear, and those opportunities only appear during periods of extreme stress. It also protects you from being forced to sell other assets at the worst possible time, which is exactly what happens to most investors who are fully invested when a crisis hits. The fourth asset is productive real assets, assets that generate real income and are tied to tangible economic output, such as agricultural land, rental real estate, infrastructure, and similar investments. These assets have two powerful advantages that paper assets do not. They generate income regardless of what is happening in financial markets, and their supply is inherently limited. You cannot create more farmland with a policy decision, and demand for essentials like food, shelter, and energy does not disappear during economic downturns. In inflationary environments, these assets often increase in value because the income they produce rises along with the general price level, which means they not only preserve purchasing power, but can also grow it over time. Allocating 10 to 15% of your portfolio to productive real assets adds a layer of stability and real-world value that is not dependent on financial market conditions. Now, understanding these four categories is only part of the equation. Execution is where most people fail. They either overreact and make extreme decisions all at once, or they delay action until the opportunity has passed. The correct approach is systematic and disciplined repositioning. In the first month, you assess your entire portfolio honestly. Look at every position and ask whether it will preserve your purchasing power in an inflationary debt crisis, and begin reducing exposure to assets that clearly will not. At the same time, you initiate your position in physical metals, even if it is small, because starting the process matters more than waiting for the perfect moment. In the second month, you begin building positions in high-quality businesses with pricing power, while increasing your allocation to liquid assets. And then over the following 3 to 6 months, you continue this process gradually, shifting capital away from vulnerable positions and into the four core categories. By the end of this period, 70 to 80% of your portfolio should be aligned with these assets, while the remaining portion can be adjusted based on your personal risk tolerance and time horizon. The key to success during this transition is ignoring short-term noise, because markets may continue rising temporarily, and during that time it will feel like you are missing out, but you are not positioning for the next few months. You are positioning for the end of a cycle that happens once every generation. Most people around you will not understand this. Many advisors will not agree with it, and financial media will not emphasize it, because they are all operating within frameworks designed for normal conditions, not for structural transitions. We are currently in stage 7 of a long-term debt cycle, and stage 8 is approaching, and when it arrives, it will not provide a warning or a second chance. That is why the next 12 to 18 months matter so much. So take action now, open your portfolio, and evaluate every position with complete honesty. Ask whether it will protect your purchasing power in a scenario where inflation accelerates and markets become unstable. Then create a clear 6-month plan and follow it with discipline, regardless of how you feel in the moment, because emotions are what cause most investors to fail. Fear forces selling at the bottom, greed drives buying at the top, and hope keeps people holding positions that are already broken. Discipline is what separates those who lose wealth in these cycles from those who preserve and grow it. And now you have the information needed to be on the right side of that divide.